Good morning. Happy Friday. We're going to go ahead and get started with the Senate Finance Sub of Capital Outlay and Transportation. And we're going to do a brief round of introductions. I'm Jeremy McPike, Senate District 29, representing Stafford and parts of Prince William. Senator Openchain.
I'm Mark Openchain, represent the 2nd Senate District, Rockingham, Harrisonburg, Augusta, Page, Highland, and the soft spot in Senator Deeds' heart, Bath County.
My name's Cree Deeds. I'm in the 11th District. I live in Charlottesville.
Mimi Locke, I represent the 23rd District. Mark took the 2nd. So I'm getting all of his emails. So I represent the cities of Hampton and Newport News.
Hi, I'm Jennifer Boysko. I represent the newly created 38th District, which is Northern Fairfax County.
And our Senate Finance and Clerk team, go ahead.
Yes, Tyler Williams with the committee, responsible for capital outlay.
Kendra Brown Shiflett. I'm with the committee also, responsible for transportation.
Jonathan Palmore, I'm Senate Clerk's office. I'm responsible for technology.
All right, we know who to call to if things go wrong this morning, right? And we also have April Keys on the phone that is also joining and listening in as well. So good morning, April. And this morning we have a review of a Commonwealth debt and debt capacity. We have today our State Treasurer David Richardson. Good morning.
Advance for you will have heard some of this information, so I'm going to go through it relatively quickly, but please stop and ask questions along the way. I think it's a small group, and I'd really love to have some dialogue. If you have some specific questions, I'd be happy to stop and answer them. With me here today, Brad Jones is our Director of Debt Management, and next to him is Richard Rodemeyer, who's the architect of our debt capacity study that we do annually. So we got the brains in the room who can answer the questions. What I'm going to do today is to go over it's just two main issues. One is debt, and the other is debt capacity. So the Commonwealth issues debt through a number of different issuers, and under the different sections of the Virginia Constitution, you'll see that Article 10, Sections 9, B, C, and D. We refer to those all the time, and I'll try to explain exactly what those are. And then the most important thing, I think, and most interesting is the debt capacity study that we do on an annual basis based on the revenue forecasts and the existing debt structure that, and the authorized and unissued debt that we know we're going to be issuing. So we come up with a debt capacity number that is designed to make sure we retain our AAA bond rating and are fiscally conservative in how we issue our debt. So that's what we're planning to do today. So the types of issuers that issue tax-supported debt, the Treasury Board issues general obligation bonds. The Virginia College Building Authority does what you would think it would do. It issues debt for Virginia colleges and universities. The Public Building Authority issues debt for public projects. For example, if this building were debt financed, it would be this building or any public project that the Commonwealth would own. And then the Commonwealth Transportation Board and the Virginia Port Authority also issue tax-supported debt. The Virginia Resources Authority issues debt that's based on a moral obligation of the Commonwealth, and the Virginia Public School Authority issues debt that's based on some sufficient appropriation. So those are typically not included in our debt capacity model, but they are important and very frequent issuers. So this is the alphabet soup of the Constitution. 9A debt is, we hope we never see it, because if that ever happens, it means there's been a serious problem and we had an emergency that we had to issue some debt for. I can't imagine that scenario, and I don't want to. So that's never been used and hopefully never will be. The 9B debt is general obligation bond debt. And the key piece there is that if you look under the heading referendum, you'll see that 9B debt requires a referendum of the voters. And that doesn't happen very often because it's very difficult to find a consensus for this diverse Commonwealth where you're going to be able to find projects geographically spread out around the Commonwealth that are going to be palatable and interesting to the voters. So it's very difficult to get a general obligation referendum passed. The last one was done in 2002. So it's best to do it that way if you can, because that uses our AAA bond rating and will get us the lower cost of capital. But the practicality of doing it is really a big challenge. 9C debt is where you have revenue-producing projects. That's typically by universities that are doing dormitories or dining facilities, and they're going to be self-liquidating because the dorms generate revenues, the dining facilities generate revenues. They have to do a feasibility study that shows that the revenues are sufficient to pay the debt. And so we put the general obligation of the Commonwealth on top of that, so we get the lowest interest rate, but we don't count it towards our debt capacity model because it is self-liquidating. And 9D is where the vast majority of our debt is issued, which is subject to appropriation debt by the General Assembly. And we'll get into some of that a little bit more. And this is just a summary of what I said before. Like I say, the 9B is AAA rated. The 9C is AAA rated because the general obligation bond, the general obligation of the Commonwealth is put on there. The 9D debt is subject to appropriation, so that usually with the rating agencies is a click below the AAA bond rating. So it's, as you see, AA plus is usually the rating on that. And so there's an interest rate differential between the general obligation and the subject to appropriation debt. But frankly, given the fact that the Commonwealth's debt is all fixed rate, 100% fixed rate, the rate environment we're in right now, which is a little higher than what it's been in the past, it's a lot higher than what it's been in the recent past, but it really isn't having that dramatic an impact on our debt load because all of our debt is fixed rate. So these incremental amounts we're issuing now, while we wish they were at lower rates, it's not killing us. This will show you sort of a breakdown of the types of debt that we just talked about. The dark blue on the bottom is the general obligation debt, which is, as you can see, is shrinking as it gets paid off. So we haven't done one since 2002. And then the light, I guess that's light blue, light green, or something like that, is the 9C debt, which is the colleges and universities that we spoke about before. That's self-liquidating debt. And then the big blue is the 9D, which is the subject to appropriation debt, which is obviously the vast majority of the debt that we issue. And this is our, the dark blue here is the authorization by the General Assembly of our debt. So you can see it's very lumpy. Some years there's a lot authorized. In the last 2 or 3 years, there's been virtually nothing authorized. And the greenish color is the actual issuance of the debt. So there's a lag time between the time it gets authorized and the time it gets issued. Sometimes a long lag time, but you'll see in like 2020 here, there was a lot of debt that was authorized, but that it didn't get issued until 21, 22, 23. Now, in the current budget proposal, there's tax-supported debt of the around $500 million. So you can if you could sort of imagine a dark blue box there in 2024 at the back end, that's what's been proposed in the budget. Now, it's totally, it'll be totally up to you guys as to what actually gets authorized, but that's what's in the initial proposed budget. So it's higher than it's been in the last 3 years, but compared to earlier years, it's not really all that not really all that high.
Senator McDougall.
Mr. Chairman, can you explain how is the authorization number lower than the issuance number over the last 10 years?
Yeah, the authorization will come in, but the bonds don't actually get issued right away. So you'll have a project that's authorized, but it'll take a couple of years to do architectural design work and things like that. And so that there's a lag. Gets authorized, but then it doesn't get issued for a couple of years. Is that what you were looking for?
Just, Mr. Chairman, it just looks like we've spent close to $500 million more once we issue the bonds than what we authorized. And so that's why I was trying to understand where that delta came from.
Well, I think it's just a timing issue. That's in the last 10 years. I think it's if you went back further, it would equalize. I think that's just a factor that we have a snapshot of 10 years, and it doesn't go back to 2013 and 2012. There's sort of a disconnect there. I see that. And this is what we use the debt for. As you can see, higher education, when you put in higher ed and then the higher education teaching and research equipment, you'll see that that's 57% of the debt that we issue. And then you've got transportation is about 16%, which and the rest of those, the correction facilities and the other state buildings and public and mental health, those are all Virginia Public Building Authority issuances, which are going to be about 27%. But you can see higher education really dominates our debt issuance. And this is a slide that I always find a little scary, but I think if you dive into it and you understand how Virginia is run from a fiscal standpoint, what this says is that Virginia has a high debt number compared to the other AAA states and to all the other 50 states. Now, that being said, some of these states are AAA because they really don't have any debt to speak of, and so they sort of skew the median. And the rating agencies, notwithstanding what this looks like, the rating agencies, every time they do a report, will tell us that our debt load is fine. They cite our diverse economy, they cite our fiscal conservatism, and they also like the very fact that we'll get into the debt capacity advisory study in a minute. They really like the fact that we have that discipline. And so all three of them have reaffirmed our AAA rating in the last few months. And this is per capita, this is as a percent of personal income, and you'll see the optics are such that it looks like our numbers are high, but trust me, we have this dialogue with the rating agencies all the time. We have calls with them set up in a couple of weeks, all three of them, to go over the most recent budget proposals. So we're going to have a nice dialogue with them. It's a good time to be treasurer of the Commonwealth of Virginia with $30 billion in the bank and revenues maxed out at the 15% limit and everything else. It's a nice time to be treasurer because this AAA rating is in really good shape. Now, the shifting from the debt itself, the mechanics of the debt and what we do with that, and going to the debt capacity advisory study, this is something that's been around for a long time. What the code requires is that the Debt Capacity Advisory Committee provide a report to the General Assembly by January 1st of every year, analyzing the appropriate amount of debt that we could issue prudently. And that includes a review of all the existing debt that's outstanding and all the authorized but unissued debt as well. And it also, we also have to take a look at the moral obligation pledges and see if they've been hit, things like that. So what happens is this committee is comprised of Secretary Cummings, me, there's two at-large appointees, April and Ann Oman from the House are on that committee, Hal Greer from JLARC, Michael Mall from the Department of Planning and Budget, Stacy Henshaw, the Auditor of Public Accounts, and then Sharon Lawrence, the Comptroller, are on that committee. So it's a pretty well-versed committee in finance, and they get together usually once a year after the revenue forecast comes out and after the budget gets released, and because we need the revenue forecast to do the analysis. The royal we really is Richard, not me. But obviously debt affordability is a key factor. If we issue more debt than we really should, we could erode our credit rating. Nobody wants to see that. And most states do some sort of debt capacity analysis, but I will say I'm very proud of our debt capacity model because all three rating agencies cite that debt capacity model in their reports every year. The sophisticated model, they really very much like it.
Senator Deeds.
How long was that case rated? They mentioned the debt capacity model. So, say every year, how far back?
At least the last 3 or 4 years. I'm not sure. Yeah.
My point was, it's not really a Democratic or Republican thing.
Oh.
It's something we all manage.
100%. And I said this last year, but it was just a little anecdote because when we went to see the rating agencies with the governor and Senator Barker and Delegate Knight a year and a half ago, I think it was Senator Barker said that when it comes to the finances of the Commonwealth of Virginia, there are no Republicans and there's no Democrats. They're just Virginians. I don't know if that's true or not, but it really went over well. And I told him, you got to say that 2 more times with the other rating agencies. But I really do think that's been the Virginia way. I think the finance piece of the Commonwealth has been almost just bipartisan. I mean, everybody's focused on what's right. And I don't think it's been as much a political football as many other issues. I think the finance is sort of over here in a place where everybody's on pretty much the same page. At least that's been my experience. So here this goes to your point. We've had AAA ratings from Moody's since 1938, S&P from 62, and Fitch in 1991. And bond investors love Virginia paper. I mean, there are 14 other AAA states by all three rating agencies, but the Virginia paper, if you were issuing the Virginia paper the same day you were issuing something from Ohio, the Virginia paper would trade better. It's a very popular name in the debt world, and we're very proud of that. So what we look at in the debt capacity model is the tax-supported debt, because there's debt that's debt, but it's not tax-supported. And so one of the examples was the 9C debt, the dorm and dining kind of debt that comes up. And there's also the Virginia Public School Authority. They issue the debt, but the localities are really paying for that debt. So it's, we try to figure out which tax-supported and what isn't tax-supported. And so we've come up with this model. What we try, and the model is basically we don't want our annual spend to be on debt to be more than 5% of blended revenues. That's the fundamental cap that we're looking for. And as you see here, blended revenues are general fund revenues. There are other ABC, sales tax, the healthcare fund, and the TTF are counted in that. So we do that model. We count tax-supported debt that counts is our general obligation debt, and it's also the Virginia College Building Authority debt where that's subject to appropriation. And their long-term leases, the accounting changes that have affected long-term leases and other types of accounting changes have caused some things that used to be expense items to come over into the debt category. So we count those. And what's not counted is like the 9C debt we talked about, moral obligation debt from Virginia Resources Authority, and the Garvey bonds, things that have other sources that are paying them or not. So there's been a lot of thought given to what's in the debt, what's a tax-supported debt and what isn't. And the rating agencies generally agree with our approach, although there's some differences on the margins because they're not always consistent. So we count the existing debt that we have, obviously, which we can't do anything about, and then we also look at the debt that is authorized but yet unissued. We still have a fair amount of that. It's $3 billion. And then we estimate when those deals are going to get done and at what rates they're going to get done at, and then we build that into the model. We do not include in the model, Tyler, the what's in the budget. So, for example, we have money in the budget right now, or debt that's authorized in the budget. We don't put that in the model because, frankly, the General Assembly hasn't disposed of that yet. It's not done. And I think we use the debt capacity model to sort of provide you with some guidance as to what a prudent level might be. So part of the decisions in the debt capacity model, one of them is main number is interest rate. Well, normally we do the average interest rate for the last 12 quarters, but with the big spike in rates that happened over the last couple of years, when you do that number, it's 3.05%. Well, that doesn't work. It's not real world anymore because the rates went up so fast and so high. So we basically had to go talk to our financial advisors, talk to the Secretary of Finance, do our own analysis, and we came up with an assumption in this year's model of a 4.75% rate. And that's got a fair amount of conservatism built into it. But that's the Virginia way. We don't want to just guesstimate something that we can't justify that's too low, only to find out that rates go up. And I think right now there's a lot of uncertainty. Most people thinking their rates are going to come down, but then inflation was up this week a little bit, and Chairman Powell is making noise about, well, maybe not so fast. So we don't really know what's going to happen with that. But we want to be conservative. That's why we used the 475. And this is the authorized but unissued debt. And you can see there's $3 billion out there already that even if no new debt is authorized this year, we still have $3 billion that'll probably come into play here pretty soon. Just as an example, the Virginia Public Building Authority, what the Public Building Authority does is they'll issue debt, and then not for necessarily specific projects, but they create a pool of funds that can be drawn on as projects are authorized. And so it depends on how much demand there is for capital projects. And we have to be careful not to issue too much too early, because under the tax rules, the faster you spend that money, you can actually keep the investment earnings on it that are higher than your bond yield. It's an arbitrage play. So you don't want to issue too early because you run into tax problems. And obviously, you don't want to issue too late because then you run out of money and you can't fund it. So we really work with DPB and with the agencies that are going to be looking at using these proceeds to try to come up with a timing on that. So we work on that. We meaning, once again, Brad, not me.
How do you deal with bond proceeds where you do have excess until it's actually expended?
Well, they're invested, and the proceeds stay in the fund, and so they can get used. Unfortunately, the investments that are allowed are pretty conservative investments because you want to make sure they're there when you need them. And so it's not, back when rates were zero, we were earning nothing. But right now, it's pretty good because short-term rates yield curve is still inverted slightly. So it's not a bad thing to have unspent bond proceeds right now. But under the tax rules, you got to be careful because our bond counsel will yell at us. So the main takeaway for the debt capacity model is that it's a snapshot. So we take a snapshot on December 21st of this year. We looked at the revenue forecast. We looked at interest rates. We looked at all the debt that's been authorized, unissued, and we came up with what we think is the debt capacity that would keep us at that 5% level. But I keep that capacity report on my desk because as rates change during the course of the year, and then the revenues are just a forecast. I mean, sometimes they're going to meet the numbers, and sometimes they're not. And so as those things move around, the amount that's authorized, you can look at it and go, well, maybe it's more than that, or maybe it's less than that. I mean, it's just a snapshot, and the only thing we know about it is that it's wrong. As time changes and rates change, it's just going to be wrong. So the punchline is, doing all of that math, we end up with $1.06 billion in debt capacity in each of the next 10 years. And you can see that the model there shows that it keeps us under the 5% blended revenues, and that's a lot of debt. We're not suggesting that that's a target. but that's just what we could issue prudently over the next 10 years. This is not mandatory. It's not binding. It's just advisory. It's advisory to governor and you, and as you go through your deliberations about what's going to be included in your capital spend and what's going to be debt financed and what's going to be cash financed. It's just something to keep in mind as you go forward.
And Mr. Chair,
Senator Deeds.
the 5%'s not statutory either, is it?
No. That's just a number. Frankly, I don't think the rating agencies would blink if we decided to do something different. What they like is the fact that we actually have a number.
Okay.
You know, that's really the key. And and it's worked well for us, so we're not inclined, and if they're going to say good things about it in the rating report, we're not inclined to mess with it.
Yeah.
So, like, once again, it's a non-binding, and this year, as I said before, there was been about $500 million was included in the budget. And so if the $500 million was actually issued, the impact of that on the debt capacity model and the 10-year average would be about $42 million a year.
Can I ask,
Senator Deeds.
an earlier graph about that 16% of the debt is related to transportation projects. I assume those are mostly Garvey debt? That's mostly Garvey debt?
I think that's right, yeah.
Okay.
It's mostly capital projects, revenue bonds, CPR bonds. There's also around 58 bonds as well.
Oh, yeah. And 81?
Capital projects, revenue bonds, and also around 58 bonds of extent.
Yeah. So I'll stop there and happy to answer questions. So the material's a little dry, but I think it's pretty important.
Thank you for the presentation. Questions from the committee? It's a little
Thank you
slow
so
on Friday. I
much.
think it was very thorough. Lots more to come on this. It's helpful to have a baseline of projections and sort of ground us in some of the prior North Star information in terms of what we're able to do capacity-wise and still keep us on track. So thank you so much.
Yeah, as you go through the session, obviously, April and Tyler are the main resource, but you can just reach out to any one of the three of us if you want some information, and just, you know, if you follow-ups, just feel free to reach out.
Thank you so much.
Thank you.
Appreciate you and your team's time and effort this morning.
Happy to
And I'm sure we'll be following up on lots of other questions as we go. All right, Tyler, we're going to take a look next week, I think, at transportation and Capitol Square project updates. Is that correct? All right. Well, I think that completes our agenda for this morning. Any other notes, Tyler or team? All right. Committee will rise.
The Senate of Virginia, Richmond.